What's next for Canada? On June 23rd, BMO hosted a discussion with industry experts to dive into the evolving Canadian political and economic landscape following the election of Prime Minister Mark Carney. Let's take a listen.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
Good morning and good afternoon across the country. Welcome, everyone. Welcome to BMO's discussion on the evolving Canadian political and economic landscape following the election of Prime Minister Mark Carney. I'm thrilled that everyone can join us today. We're having the discussion at a pivotal moment in Canadian and global affairs, just days after the conclusion of the G7 summit, which was held in Canada. We find ourselves at the intersection of renewed leadership, shifting global alliances, and changing economic priorities. Accordingly, we wanted to bring our experts for a quick 30-minute discussion on what the new administration means for Canadian businesses and investors. I'm George Shrapkoff from BMO Private Wealth, and I'm honored to be moderating today's discussion. Today's session will go very quickly, so I want to get started right away by introducing our panelists. First, we have the Honorable Scott Bryson, Vice Chair of BMO Wealth Management, Michael Gregory, Deputy Chief Economist at BMO Financial Group, Randy Ollenberger, Managing Director, Oil and Gas, BMO Capital Markets, as well as Devin Dodge, Industrials Analyst at BMO Capital Markets. And to start, I thought it would be most useful if we had each of our panelists provide high-level overviews of how they're seeing the impact of the new administration in their respective areas. Scott has a long and distinguished career in politics, and we're very happy that he can join us to provide his views on the global political landscape and implications for Canada and Canadian businesses. Scott, please go ahead.
Thank you, George, and looking forward to the conversation. I think, first of all, politics changed in Canada as a result of the Trump administration, Trump 47, being dramatically different than Trump 45, that administration, much more emboldened and less constrained and much more apt to be unpredictable in many ways. The tariff threat to the Canadian economy really did create a seismic shift in how Canadians were viewing politics at the time of the election. And the ballot question became, who can best deal with the President Trump's tariff threat to a country like Canada that depends on the U.S. for over 70% of our exports. But secondly, who can manage the Canadian economy to build a more resilient Canadian economy and a more prosperous and growth-focused Canadian economy. And so Canadians in the election chose Prime Minister Carney to do that. They still want change. They did not vote for, and the Conservatives, their message, do not vote for a fourth Liberal mandate. That was a clever question in many ways, because if Canadians thought they were going to get more of the same, they perhaps would be less inclined to vote Liberal this time. They voted for Mark Carney because they believe that he represents the kind of change that Canadians want and can trust. Since then, if just a couple points, the relationship with President Trump has improved dramatically. The fact that President Trump refers to the Prime Minister of Canada as the Prime Minister of Canada, not Governor of the 51st state, is more than symbolic. It is substantially reflective of a more solid relationship. My understanding is that there's progress on individual areas of Prime Minister to President and Minister to Secretary between the cabinets. Secondly, diversifying the trade relationship has been a focus of Prime Minister Carney from the beginning, even before the election. In his first week of office, his first trip was to Europe. The Canada-Europe economic opportunities very significant. Canada has a free trade agreement with Europe, the CETA agreement, but there's a lot of room beyond that to really operationalize that. The Prime Minister has rebooted, or is in the process of rebooting and reinvigorating Canada's relations with India, countries like India, and Saudi Arabia, China, important trade and economic partners to Canada, and ones with whom the relationship had some setbacks under the Justin Trudeau's time in office. Prime Minister's also indicated that on the fiscal side, he is going to operate balance the operating budget of the government of Canada within 3 years. And that's a significant challenge to achieve, but it's important. Government spending has grown by 9% per year for about a decade now, and public servants, it's gone from about 250,000 to about 350,000 federal public servants. And we struggle to provide high-quality digital services, from a blockbuster video government serving a Netflix citizenry. So it's going to be really important, something that sounds dull to many government operations, I think, are going to be focused on, and you'll see a real focus on getting spending under control. Growth, the Prime Minister's One Canadian Economy commitment, getting rid of interprovincial trade barriers largely by July 1st, is ambitious. There's a lot of work from provinces and unity required, but there seems to be broadly a consensus on that. The major projects focus and getting the barriers out of the way and making it a more streamlined process to get major projects approved. Pipelines can be part of that. It could also be mining projects, could be LNG projects. The Prime Minister has clearly stated he wants Canada to be an energy superpower in both conventional and clean energy. The expectation levels are high. Minister Tim Hodgson has a big job to do, and the Prime Minister has his back. So I think things are aligned properly. But again, this is a honeymoon period still, and people want the candidates to succeed and for the Prime Minister to succeed. But there's going to be challenges to get there, but early signs are very positive. Also, infrastructure, and getting the infrastructure that Canada needs in a tight fiscal situation with already significant deficits and a growing debt to GDP number and a potentially slowing economy. All of these things are being worsened in some ways by a really significant increase in defense spending to meet not just NATO targets, but a post-Bretton Woods global defense environment. It's very clear, and the Prime Minister has stated that to build the major projects, infrastructure, transportation, social infrastructure, even things like housing, it can't be just on the government's dime in tax dollars. There's going to have to be a harnessing of institutional investment, pension fund investment, potentially sovereign wealth fund investment. And so you can expect to see more public-private partnership where government money is leveraged with institutional investment. All in all, I think that he's representing at this stage a pro-business, pro-growth economic perspective and still a progressive government. So kind of a business-oriented liberal that progressive conservatives would feel comfortable with. And so far, his support is maintaining, but the expectations are high and he's going to have to deliver.
Awesome. Thank you very much for that, Scott. Very helpful. We always appreciate your insights into Canadian and global political landscape, given your great experience in politics. Michael, do you want to give us an overview of how you're seeing the potential impact of the new policies and impact on Canada?
Sure thing. Hi, George. So listen, the bottom line is this, that Canadian economic prospects are improving. We currently look for real GDP growth to average 1.3% this year and next. And that contrasts sharply with the 0.5% pace that we were expecting back in March and early April, when we had sort of the peak uncertainty concerning tariffs in the US. Now, given the 1.3 is an improvement, keep in mind that before the trade war started, we were looking for growth to be pushing close to 2%. Now, there are two reasons for the improvement. One of them is the trade war itself, and tariffs are proving to be not as onerous on the Canadian economy as was feared. And the second factor is that the pro growth tilt to government policy under Prime Minister Carney, and the fact that a lot of these policies are being executed in an expeditious fashion. Okay, quickly on the first point on tariffs, we know how that scorecard sits right now. The 25 or 10% fentanyl-related tariffs are only on goods that are not compliant with CUSMA. And of course, day by day, the amount of goods that are compliant continues to rise. So that was better than expected. The 25, now 50% tariffs on aluminum and steel. There's no way to say anything but the fact that that is much worse than expected. The 25% tariffs on automobiles and parts, again, turned out to be a little bit better than expected. On the assemblies, on the automobile side for cars assembled in Canada, the U.S. content of that gets carved out, and for the Canada's fleet, that's about averages about 50%, and of course parts were completely exempt. And finally, Canada did not get caught in the crosshairs of reciprocal tariffs. So when you kind of add that all up, the burden of tariffs on the Canadian economy is lighter. But what is not lighter, though, is the impact of U.S. trade policy uncertainty and tariffs broadly on confidence. Confidence continues to continue in a sort of an eroded fashion, and of course that is spilling over into trade policy related business investment. And quite frankly, we're unlikely to see that investment perk up or confidence show signs of being restored until we clear up this uncertainty about trade policy. And that's where the government's mission to get a trade and security deal inked and signed potentially by sometime next month, it could go a long way in restoring some of that confidence. It's unclear. Trade deals, have been signed between our two countries before, and some aspects of it have not even been honored. So the bottom line is that it may take a little bit longer than merely inking a deal before confidence comes fully back. But the other aspect of why we've upped things is purely on the policy side. On the tax side, we've seen just from the get-go that the consumer carbon tax was axed, along with the GST on new homes purchased by first-timers. The 1 percentage point reduction in the lowest tax bracket actually kicks in a week tomorrow. And this provides a lot more money in the hands of Canadians, presumably going to spend and help the Canadian economy along. Scott's already mentioned that defense spending is picked up. The campaign promise to get to 2% of GDP by 2030 was expedited to get to 2% this fiscal year. Again, a huge boost to spending. A lot of the other the platform spending measures that were announced, given that we don't have a budget to go by, those are the kind of things that look like they're going to continue to add to growth going forward. And in fact, we do think that we'll probably get on average about a 0.5% boost to GDP growth still by all of these policies being expedited going forward, and now we saw with the One Canadian Economic Act that getting those medium-term infrastructure projects kind of expedited will also provide that lift for growth. So it also begs the question, can we get back to 2% where we were before? Can we surpass that? Well, there's a chance we could. There's no question, particularly if we do get some of these nation-building infrastructure projects expedited. But I guess the question has always been raised, well, can we outpace the rest of the G7 in terms of economic growth? And the fact is, the rest of the world is not standing by, of course. We're seeing a huge infrastructure defense spending in Germany and other parts of Europe. Of course, in the south of the border in the US, they aren't standing by. It looks like we're on a fast track here to deficit finance tax cuts, at least for a few years, which of course would be a tremendous boost to the US economy. So I think Canadian prospects are improving. Can we top the G7? Well, we'll just have to see what happens. I'll leave it at that for now.
Thank you, Michael. This is very helpful. So let's turn over to Randy Ollenberger to give us an overview on the oil and gas sector and the opportunities and as we are trying to build the energy superpower of the world. Randy?
Great. Thanks, George. Yeah, I mean, the Canadian Oil and Gas Group is, I think, very cautiously optimistic about what they've heard from Prime Minister Carney and his desire to build an energy superpower here. I think the industry is very hopeful that we see some additional LNG facilities built off the west coast of Canada. We have one starting up right now, LNG Canada Phase 1. We have two others that are in the pipeline that are expected to start up in 27 and 28 that are a bit smaller, cedar and wood fiber. But Phase 2 of LNG Canada is something that, the federal government could certainly help the project partners with some confidence around, what the regulatory framework would look like for that facility. And that would be very beneficial for Western Canadian natural gas producers as it's a meaningfully sized facility. And that would, again, allow the industry to continue to grow and continue to invest. There are other LNG projects on the west coast of Canada. And again, anything the federal government can do to help facilitate those, whether it's working directly with the project sponsors or with the British Columbia government, which also has a very significant role in all of this, could be very positive from an investment perspective for the oil and gas industry in Canada, because you have to remember it's not just the investment in these facilities themselves, which is quite substantial, but it's the investment in drilling those incremental natural gas wells and all the services that come along with that. Now, media attention often is focused on the oil pipelines and what might happen there. I think what the industry is looking for really is a lot of certainty around the regulatory environment there. TMX was not a good experience for anyone from the perspective of how long it took, but also more significantly, the cost. And so simply, if the federal government indicates that they're prepared to allow some of these oil pipelines to be built, whether it's Northern Gateway or some facsimile or an expansion of TMX, the project sponsors are going to be reluctant to go ahead with those projects if it's going to cost what TMX cost. That really wouldn't make a lot of sense. So you need not just regulatory certainty around the timeline, but also, the conditions on the ground in terms of what are the sorts of things you need to take into consideration to build those pipelines. Now, something that gets lost in all of this as well is pathways and the carbon capture part of that equation. So I think Prime Minister Carney has talked about, a desire to sell the world low carbon barrels, and pathways would be a big part of that. And so I could envision where these pipelines, the quid pro quo for that is that the oil and gas industry moves forward with the carbon capture projects that have been really on hold through this period of political uncertainty and represent in and of themselves a very significant investment. Pathways, the first phase of that was originally envisioned to cost maybe $75 or $80 billion. $100 billion wouldn't be unrealistic. So you start thinking about, the total investment opportunity here in pipelines, in pathways, in drilling additional oil and gas wells, in building additional oil sands facilities to fill up these pipelines. And we were talking about potential capital expenditures that run into the $200 to $300 billion level, which, we believe would be very significant for not only Alberta and British Columbia, but also Canada as a whole. So there is the potential here to see significant investment made by the oil and gas industry, not only in, as I said, production, but also in carbon capture facilities that facilitate some of these pipelines and facilitate the government's ambition to be an energy superpower. So I think cautiously optimistic is a good way to describe it all. I mean, none of this has been laid out yet in terms of what the framework would necessarily look like, what the approvals would look like, but also, those on the ground conditions in terms of what are the environmental hurdles at a local level that you have to deal with to build these projects, because no one in the industry really wants to see another $30 billion pipeline. They're really thinking that the only way path forward here would be if you can build these pipelines much less expensively. I mean, keep in mind, TMX was originally supposed to cost $7 billion and ended up costing $13 billion. Coastal GasLink was only supposed to cost $6 billion, ended up costing 12 or more billion dollars. So, the incremental costs that can get layered onto these types of projects can make them uneconomic. And the federal government also has a role to play there. So there's still a lot of things where the industry needs clarity on. But I think, if we continue to move forward down this path where the government wants to see these things done, where it's encouraging the industry, encouraging project sponsors to move forward and creating the necessary conditions, we could be looking at an environment where, as I said, you see several hundred billions of dollars of incremental investment made in Western Canada over the next 5 years that benefits Canada more broadly. I can leave it there, George.
Thank you very much, Randy. This is a great recap. And as you talked about, it's $200 to $300 billion of capital expenditure over the next few years. So let's see, what Devin Dodge thinks about this project and where there's the opportunity. What are his thoughts, the overall industry impact on Canada? Devin?
Yeah, thanks, George. Afternoon, everybody, or good morning, depending on where you are. So look, our comments are largely focused on these nation-building projects. Look, I think Randy gave a very good, provided a good perspective on some of the energy projects that, could be coming forward here. From our perspective, it does seem like it's a lower bar to get some of these natural gas projects across the finish line. That would be largely LNG export facilities, but also potentially, some pipelines to feed those facilities. And that would be potentially more meaningful for a lot of our coverage companies. Crude oil, seems like it's going to be tougher to get some alignment across all those various stakeholder groups. But to the extent that additional pipeline capacity comes online, I think it'll have to be augmented by some carbon offsetting projects. I think Randy mentioned Pathways is probably the most visible there. At the top there, I think Scott mentioned that Prime Minister Carney was, focused on getting Canada to be an energy superpower. And again, I would emphasize this is taking a broader view than just traditional fossil fuels. It seems like renewables and low and carbon-free energy sources such as hydro, offshore wind, and nuclear, increasing the optimism there, is part of that objective. Beyond energy, we expect a range of projects that could be considered for by the federal major project office. On the infrastructure side, look, Canada has a very well-developed model for developing traditional infrastructure. We think we could see more, we're calling it non-conventional infrastructure investments. This could be investments in Indigenous communities. It could be investments in infrastructure in northern Canada, particularly around ports and access routes to those ports. Again, getting Canadian resources to tidewater. I think we're likely to see more east-west electricity transmission to the extent that interprovincial trade barriers can come down. And then on the resource development side, I think the BC government's been very proactive in highlighting, let's say, opportunities for some mining investments, maybe particularly in the Golden Triangle. In Ontario, the Ring of Fire, this has been around for a couple of decades, has been a lot of progress there to date, but potentially this could be a catalyst for bringing that forward. The other thing to mention here is that really want to reemphasize the timing. The federal government is looking to fast track these approvals. They're aiming for 2 years. That's a big improvement from the current state, at least when we think about resource and energy projects. But those project schedules may not have shovels in the ground until 2027 or 2028. So within our coverage, who could see the benefits? I think there's two main groups. One would be engineering consultancies. The second group would be heavy equipment dealers and construction companies. So for the engineering consultancies in Canada, that means WSP, it means Stantec, and Atkins Realis. Currently, the demand backdrop for these guys, very strong. They're really just at the center of a multi-year and arguably a multi-decade spending trends. So these would be infrastructure, climate change, climate resiliency, energy transition, energy independence, reshoring. There's just a lot of positive things going on. And we would argue that any individual one of those would be meaningful for the sector, but to have them all at the same time just really paints a very positive backdrop for the group. If we narrow focus to Canada, I think activity levels in Canada and the backlogs, they're actually elevated right now. Activity levels are good. I think this gives us good visibility into demand in the next 12 to 18 months. So these nation-building projects, we think the net benefit here is largely on extending that window of visibility beyond that 18-month window. If we get anywhere close to the couple $100 billion that Randy talked about, that would be very positive for the group. I think it's also interesting to note that the engineering consultancies, they can generate some revenues before final project approval. They have a lot of services geared to kind of upfront, whether it's advisory, planning, permitting, environmental assessments, indigenous consultations, et cetera. I think as far as specific winners, hard to know for sure. I would say just generally the whole group should benefit, and specifics will depend on the projects that come forward. That second group that we're going to talk about, heavy equipment dealers and construction companies, we paired these together largely due to the timing of the benefit, which is likely later this decade. But industry conditions have been, let's say a little bit more mixed. Activity levels in mining and power have actually been pretty strong. It's construction markets that are a little bit more uneven currently, and largely due to commercial and residential construction activity being a bit soft. Infrastructure development generally pretty solid. As for winners, we think it very much depends on the specific projects and the regions where those projects occur in. We'd highlight the Canadian cat dealers. So that would be Finning in Western Canada and Tormont in Central and Eastern Canada. And then amongst the construction companies, we think Aecon could be well positioned here. They're infrastructure focused, as well as Bird Construction, which is covered by my colleague John Gibson out in Calgary. But again, the last thing to emphasize here is just the benefits for this second group is still likely a few years out. So I'll leave it there, George.
So we covered a lot of ground today. Scott, Michael, Randy, and Devin, thank you very much for this very insightful discussion. I think your analysis provided a lot much needed context for our clients. And to our audience, thank you very much for taking the time to join us today.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.